Good afternoon. Since the previous meeting of the Monetary Policy Committee, the inflation outlook has improved. This was mainly due to the further appreciation of the rand exchange rate following the benign market reaction to the US Fed monetary policy tightening, as well as the significant narrowing of the domestic current account deficit. The more positive growth outlook in the advanced economies has also contributed to a more favorable environment for emerging markets generally. However, the recent heightened domestic political uncertainty has reversed some of these exchange rate gains, and the risk of further rand weakening overshadows the inflation outlook. Domestic growth prospects remain constrained, although the low point of the cycle is probably behind us. Demand pressures are expected to remain weak amid low business and consumer confidence. The year-on-year inflation rate, as measured by the Consumer Price Index, for all urban areas moderated to 6.3% in February from 6.6% in January, in line with market consensus expectations. Food price inflation, which measured 10%, moderated for the second consecutive month following its recent peak of 12% in December. The contribution of the category of food and non-alcoholic beverages to the overall inflation outcome declined from 1.9 percentage points in January to 1.7 percentage points in February. The bank's measure of core inflation, which excludes food, fuel, and electricity, measured 5.2%, down from 5.5%. This follows a recent peak of 5.9% in December 2016. Producer price inflation for final manufactured goods measured 5.6% in February, compared with 5.9% in January. The category of food products, beverages, and tobacco products decelerated for the sixth consecutive month to 8.4%, following its recent peak of 13.4% in August last year. The inflation forecast for the bank has improved, reversing most of the deterioration seen at the previous meeting of the MPC. Headline inflation is now expected to return within the target range during the second quarter of 2017, compared with the fourth quarter previously, and to remain within the range for the forecast period. CPI inflation is expected to average 5.9% for the year, compared with 6.2% in the previous forecast, while the forecast for 2018 has moderated from an average of 5.5% to 5.4%. The forecast period has been extended to 2019, with an expected average of 5.5% for the year. The improvement is mainly due to a more appreciated exchange rate assumption. Despite the recent depreciation, the current level of the rand is still consistent with the exchange rate assumption in the forecast. Although the international oil price assumption remains unchanged, the exchange rate is expected to lead to lower petrol price inflation and is reflected in a downward revision to the assumption for administered prices. The favorable trend is partially offset by a slower pace of disinflation in food and non-alcoholic beverages, driven by an expected acceleration in poultry prices in particular. Food price inflation is now expected to average 7.4% and 5.2% in 2017 and 2018, compared with 7% and 5% previously. The forecast for core inflation is marginally lower than before, at an average of 5.4% in 2017 and unchanged at 5.2% in 2018. An average core inflation of 5.3% is expected in 2019. Inflation expectations are, as measured by the Bureau for Economic Research, show a deterioration over the near term in particular. The average expectation for 2017 has increased from 5.8% to 6.2%, with the largest upward revision coming from businesses and labor respondents. The average expectation for 2018 increased marginally from 5.8% to 5.9%, while the expected inflation for 2019 is 6%. By contrast, average inflation expectations over 5 years declined by 0.1 percentage points to 5.7%. Median inflation expectations of economic analysts, as reflected in the Reuters Econometer survey conducted in March, are more or less unchanged since January. Inflation is expected to average 5.8% in 2017 and 5.5% and 5.4% in the coming 2 years, roughly in line with the bank's forecast. Inflation expectations implicit in the break-even inflation rate, that is the yield differential between conventional bonds and inflation-linked bonds, had declined since the previous meeting, but have since spiked following the recent depreciation of the rand and remain above the 6% level for longer-dated maturities. The global economy shows continued signs of a broad-based improvement. The growth outlook in the US remains favorable, with business confidence indices at high levels. However, there is growing uncertainty about the timing and the size of the expected fiscal stimulus. Tax reform may take longer than anticipated following the recent failure to repeal the Affordable Health Care Act. Growth prospects in Japan and Europe are also more promising, with the PMI reaching a 6-year high in the euro area, led by services sectors in France and Germany. The extent to which the sustainability of this improvement is dependent on the highly accommodative monetary policy stance is still unclear. The outlook for emerging markets is also more positive, in part driven by the recovery in the advanced economies and stronger demand in China. Firmer commodity prices have also helped, but an oversupply of some commodities could limit these gains. Global inflation provides a mixed picture, with the recent decline in international oil prices threatening to reverse the broad-based increases in headline inflation in the advanced economies. Some inflation normalization is evident in the US and the euro area, but Japan is showing lost momentum in price and wage growth. Inflation in the United Kingdom is expected to overshoot the target for some time as the economy adjusts to a weaker currency. Similarly, inflation experiences in a number of emerging economies have reflected divergent currency movements. The US Fed raised its policy rate in March in response to the stronger inflation trend and improved growth outlook. While this action was widely expected, the gradual nature of the expected interest rate cycle implicit in the forward guidance surprised the markets. Policy rates are expected to remain at low levels for some time in most of the advanced economies until more favorable inflation and growth dynamics are more firmly entrenched. For the past few months, the rand exchange rate has been relatively resilient, along with a number of other emerging market currencies. While most measures of the emerging market risk have narrowed over recent months, those for South Africa have widened again over the past few days. The rand has depreciated significantly in response to increased domestic political uncertainty, and the exchange rate has re-emerged as an upside risk to the inflation outlook. Since the previous meeting of the MPC, the rand has appreciated by 3.9% against the US dollar, by 4% against the euro, and by 3.4% on a trade-weighted basis. The prospect of US monetary policy tightening has been seen as a risk to the exchange rate. However, the rand and other peer currencies strengthened in response to the Fed actions in March, indicative of revised market expectations of a more moderate tightening cycle than that priced in. The rand has also been underpinned by favorable terms of trade trends. Furthermore, the improving trend of the deficit on the current account of the balance of payments has reduced the perceived vulnerability of the rand to possible capital flow reversals. However, while significant adjustment of the current account has occurred, the deficit is not expected to remain at the level seen in the fourth quarter of last year. The domestic growth outlook remains weak following the negative growth recorded in the fourth quarter of 2016. The 2016 annual GDP growth of 0.3% is likely to have been the low point of the growth cycle, and a mild recovery is expected over the forecast period. The bank's forecast for GDP growth has been revised up by 0.1 percentage points in both 2017 and 2018 to 1.2% and 1.7%, with growth of 2% forecast for 2019. While growth is expected to be below estimated potential output of around 1.4% in the near term, the output gap is expected to narrow to some extent in the latter part of the forecast period. The more favorable growth outlook is consistent with the bank's leading indicator of economic activity, which has increased for 6 consecutive months. The main drivers of growth are expected to be net exports and positive, albeit weak household consumption expenditure growth. Some impetus is expected to come from fixed capital formation in the outer period of the forecast. At a sectoral level, the agricultural sector is expected to return to positive growth following good rains in a number of regions and improved maize crop estimates. A modest recovery in the manufacturing sector is expected following 2 consecutive months of the ABSA PMI being above the neutral 50-point level, whilst the mining sector is forecast to respond more favorably to favorable commodity prices. Low growth in gross fixed capital formation remains a downside risk to growth in the short term. In 2016, gross fixed capital formation contracted for the first time since 2010, with the ratio of fixed capital formation to GDP declining from 20.4% in 2015 to 19.6% in 2016. Private sector investment remains particularly weak, having contracted for 5 successive quarters. This is reflected in the RMB BER Business Confidence Index, which increased marginally in the first quarter of 2017, but at 40 index points remains well below the neutral level of 50. The BER Manufacturing Survey shows a sharp decline in expected capital investment over the next 12 months, with the political climate cited as the main reason. The constrained growth outlook does not bode well for the employment creation in the economy. According to the quarterly labor force survey in the fourth quarter of 2016, compared to the fourth quarter of 2017, employment increased by 0.3%, whilst the number of unemployed grew by 11.3%. This resulted in an increase in the unemployment rate by 2 percentage points to 26.5%. Consumption expenditure by households, which grew by 0.8% in 2016, remains subdued amid low consumer confidence. While growth of 2.2% was recorded in both of the final two quarters of 2016, negative retail and wholesale trade sales growth in December and January underscore the likely persistence of this weakness. New vehicle sales continued to decline in February, although exports increased significantly. These trends are expected to persist as the impact of a higher tax burden, low employment growth, and weak wealth effects take their toll on consumption expenditure. In addition, credit extension by banks to the private sector continues to grow at low rates, particularly to the households amid a further decline in the household debt to disposable income ratio. Expenditure will be supported to some extent by positive but moderate real income growth. Fiscal policy, as outlined in the recent budget, remains committed to a steady pace of deficit reduction over the next 3 years. Lower tax revenues relative to budget, partly as a consequence of slower economic growth, have resulted in a shortfall to be filled by a combination of lower expenditure growth, increased fuel levies, and other excise duties, and a number of tax changes. These include limited compensation for fiscal drag and a higher marginal tax bracket for high-income earners. The tax increases are expected to act as a drag on household consumption expenditure, particularly for middle and upper income earners. International oil prices have declined following increased oil inventories and weak compliance with the OPEC brokered deal to restrict output and an increase in shale gas production in the US. Although Brent crude oil prices increased by about 10% in the wake of this agreement, these gains have been largely reversed, with oil prices back in the region of $50 per barrel for the past 3 weeks. The impact on the domestic petrol price will be evident in April, when a reduction is expected. Despite the 39 cents increase in the road accident fund and fuel levies provided for in the February budget. Since the previous MPC meeting, the inflation outlook has improved. However, the risk to the inflation forecast has been affected by the reaction of the exchange rate to the current elevated levels of political uncertainty. At current levels of around 13 rands against the US dollar, the exchange rate is still moderately stronger than the level implied in the exchange rate assumption in the forecast. However, the rand is likely to react further to unfolding developments until a greater degree of certainty and confidence is restored. The possibility of significant overshooting of the exchange rate in the short run also cannot be ruled out. As always, the MPC will attempt to look through short-term fluctuations and focus on long-term trends in its policy settings. The MPC remains concerned about the elevated level of inflation expectations. While the near-term reversal was not unexpected, given the deterioration of the short-term inflation outlook in January, the longer-term expectations remain anchored uncomfortably at the upper end of the target range. Not all the inflation risk factors are on the upside. The deterioration in the forecast at the previous meeting was due in part to a higher international oil price assumption. This assumption has not been adjusted to reflect the recent market developments. There is a downside risk to this assumption, given the possibility of these more moderate trends persisting. A further downside risk comes from electricity price increases, which could turn out to be lower than the 8% currently in the forecast from mid-2017. The final price determination by the energy regulator is yet to be announced. Overall, the MPC assesses the risk to the inflation outlook to be moderately on the upside, mainly due to the high degree of exchange rate uncertainty. The MPC sees no evidence of significant demand pressures impacting on inflation. The growth outlook remains disappointing, and the MPC is concerned that increased political uncertainty could impact negatively on private sector investment and household consumption expenditure, and further undermine employment growth. The risks to the growth outlook are therefore assessed to be on the downside. In light of these developments, the MPC has decided to keep the repurchase rate unchanged at 7% per annum. 5 members preferred an unchanged stance and 1 member preferred a 25 basis point reduction. The MPC is of the view that we may have reached the end of the tightening cycle. However, the committee would like to see a more sustained improvement in the inflation outlook before reducing rates. This assessment may, however, change if the inflation outlook and the risks to the outlook deteriorate. At this stage, let me invite you to pose any questions that you might have, and please, as usual, identify yourself and the media house that you represent. The gentleman in a white shirt.
Governor, good afternoon. Arabile Kumete from Bloomberg News. My question is, how have the effects of this week's recent events affecting the currency vastly changed your estimates that you've then given to us? Have they changed in the last week?
Okay, Madam.
Good afternoon, Governor. You say in your speech...
You are not Arabile, are you?
No, I'm Amogelang Bata from Bloomberg News. You say in your speech that the assumptions that you have for the rand are more appreciated than the current levels. Did you factor in, and if so, to what extent have you factored in the impact of political risk or uncertainty on the rand? Because we're seeing quite a lot of volatility in the currency due to those developments.
Any other? Ma'am, welcome back.
Thank you, Governor. It's Mary Misa from FinWeek. Okay, you've talked about rand volatility posing an upside risk to inflation, and political uncertainty being behind the recent bout of volatility we've seen. There's been a lot of speculation that interest rates might be cut in the second half of the year. How has this volatility and uncertainty affected the likely trajectory of interest rates? Has it affected it at all?
Just a follow-up question on her question. To what extent have the recent events and the impact thereof on the rand reduced the possibility of a rate cut later in the year? Is it completely ruled out?
Can we take the last one in this round? Tsepo?
Tsepo Moa, SABC News. Governor, you often say that you actually don't target the level of the rand, but you're more concerned about the upward movement in the currency. But if you look at the recent development, although there's been some level of volatility, but the currency has not substantially moved either way. Are you concerned about this? And when can we say that it's starting to pose a significant risk?
Hillary?
Yeah, Governor, one more on the inflation outlook. You say that you want to see a more sustained improvement, and one almost has the sense from the tone of the statement that had it not been for the round of recent political uncertainty and the risk which that poses to the rand, the committee would have been looking quite seriously at cutting rates in the near future. But my question is this. You've got CPI inflation averaging 5.9% for this year, 5.4 and then 5.5. Is that not still too near the top of the target range to justify a rate cut or a series of rate cuts? And when you talk about a sustainable improvement, I mean, would you like to see something better than that? Thanks.
Okay, there was a hand there and a hand there. Can I take this? Can we take this round and then we come back? We come back to you. Arabile, the effects of the political developments and what changes we had to make. One of the skills that is very short within central bank is political analysis. We employ economists, so we can't analyze which direction the politics are going. So, to the extent that there are political developments that have impacted on the currency, we will be concerned about the movement of the currency, because we can't diagnose which direction the politics are going, which we just not designed to be focused on that. We spell out in the statement that we have kept our exchange rate assumption the same. So the fact that there had been movements neither here nor there, we decide on assumptions a good 3 weeks before ahead of the MPC. So the developments this week didn't affect our exchange rate assumptions. And even after the movement of the currency, we say that the current level of the exchange rate still does not have an impact on our inflation forecast, because it is still, although you have had a depreciation, it is still below the assumption that we have in the forecast. And that list of assumptions is in front of you. And I guess that also deals with Amkhelang's question about the levels of the exchange rate. The assumption is very clear. Miriam, the volatility of the rand and the speculations about a rate cut later in the year, in a way, you know, the market seems to have run ahead of itself, because you have got to look at what the inflation outlook is, what the growth outlook is, what are the risks attendant to each of those outlooks in order to form a view. And I got worried that the focus tended to be the rand has done this, therefore there is going to be a cut in the later part of the year, which I had found strange. You've got to look at all of these variables and how they interact with each other. And sometimes the impact could be in opposite directions, which is why in the statement we spell out that the risks to the inflation outlook are not all on the upside, that there are things such as the oil price, such as the electricity price, which could exert a downward pressure on the inflation outlook. How all of those factors that push inflation up and those that push inflation down interact is something that we have got to deliberate, form a view and say what is then the inflation outlook, and based on that determine what the correct monetary policy stance is. But this links then to the question that Hillary raised about the CPI averages. Quite frankly, there is nothing we can do about the inflation outcome of the third quarter of this year. There's nothing monetary policy can do about what inflation is going to be this year. So to the extent that inflation ends up surprising either on the upside or either on the downside, it would not be the effect of monetary policy decisions taken today. It might be those taken in the past, because the policy horizon is between 12 and 18 months, closer to 18 months than it is to 12 months, which is why the committee keeps on focusing on the outer forecast. So the forecast for 2018 is 5.5%, and for 2019 is 5.4%. And it is based on that forecast and on what are the drivers of inflation and what risks they pose to that outlook that informs the policy stance that the MPC thus takes. So based on that balance of risks, we decided in this meeting that we will keep rates the same, and that we may be reaching the end of the tightening cycle. And we caution that there are all of these risks which could force the MPC to reassess its position. Tsapo, you had the concerns about the rent. Look, there has been nothing fundamental from an economic perspective this week that could justify the weakening of the rand. The rand movements this week, up or down, had been purely driven by the level of political uncertainty. And as I had said, if the MPC had political scientists, we might be giving you a different answer. Fortunately, we have people, unfortunately, we have got people whose job it is to beat numbers until they confess. So we focus on the economics of it. Ma'am in the white shirt.
Olivia Kumenda from Reuters. Governor, I just want to find out if the bank would consider intervening in the forex market if the political uncertainty carries on for longer and the rand continues to be volatile. Thanks.
Intervention in the FX market. Okay. There was a hand there at the back.
Yes, Governor. A question from the webcast from Peter Montalto. Governor, you have talked about looking through the short-term inflation dynamic and now forecast CPI out to 2019. Can you talk about what drives the 5.5 forecast that far out? Thank you.
Miriam?
Thank you. Right. We're not really talking politics here, but we all know what's at stake. If the finance minister were to be removed now, you must have thought about what kind of impact this might have on domestic financial markets. And would there be a risk that we would get a swift credit rating downgrade from Standard & Poor's and Moody's, which would also affect our markets and the rand and the inflation outlook?
Tsapo?
Governor, in your statement, there's a strong emphasis on the risks that are driven by internal factors, and less about exogenous factors, and this means that this kind of risk are, in our hands. Is it a good thing that we, the issue of, like Brexit and all that, although there's still a risk, but not much of an issue compared to, what you've raised in the statement? Is it a good thing that most of these risks are within our hands?
Thank you. Rashad, factors that drive the 5.5% forecast that far out from Peter Montaldo. Minele, intervention in the foreign exchange markets. Yeah, and then I will take it from there.
Thank you very much, Governor. Well, Peter, I guess that we have a convention where we want to give you a sense of the two-year forecast, and as we go into 2017, obviously we in the end of the third quarter, 2 years, as you know, is not sufficient, so we have to go into 2019. But true to say that, you know, that the moment you go into year 3 or year 4, your forecast relies on a much more difficult number of variables because it's further out. So we feel much more confident when we give you the 1 year and 2 year forecast. And as we go into the third year, we're on slightly more shaky territory. Having said that, obviously what drives the forecast for 2019 is assumptions we make about the oil price, so in a sense, you know, our 2019 forecast is assuming that there won't be a major difference from 2018. And if you look at our assumptions, it's food prices and as well as a few other variables. But as I say, that as we go out in 2019, it get late into 2017, the 2019 forecast will be more firmly grounded. So in theory, I can talk with more confidence about 2017 and 2018 than I can, frankly, to talk about 2019.
With regard to foreign exchange intervention, we have a long-standing policy in that regard that has not changed, namely that we are committed to the level of the exchange rate being established in the marketplace, driven by supply and demand in the market, and we would not intervene in the foreign exchange market with a view of trying to guide the currency towards any particular levels or ranges as such. Having said that, that does not mean that we are entirely indifferent to movements in the exchange rate. If there is excessive volatility, if there are movements that are of a magnitude or a nature that they could potentially endanger the stable functioning of our foreign exchange markets, we would consider becoming involved to restore orderly conditions. But we have not encountered that situation, and certainly the last few days have not amounted to anything close to what would require any such involvement.
Okay, Miriam, it doesn't matter which way you slice that question, it still boils down to the same thing, that politics have had a significant, political uncertainty has had a significant impact on the financial markets in South Africa this week. That's where it just boils down to. If you want to say what impact that we estimated what the impact that would have been, we haven't. But you can look back and say where were the markets in South Africa on Friday, and then what happened from Monday to today, and what were the factors that made the markets from being different from where they were last week, different from the trend they were following. Why did they deviate from that trend? You will come to the same thing. What impact would that have on the rating agencies? I would be very worried if the rating agencies make decisions on the basis of something that happened today or something that happened yesterday. As I stated before, rating agencies have to look at a multiplicity of variables which range from institutions to the economic structure, to the political structure, to the fiscal accounts, to the structure of the banking sector, and how all of those are performing. And based on that, they would form their own view. I can't make a call and say that this would have this impact on on the ratings outcomes. Of course, that credit rating agencies make decisions. It is always useful that they have got certainty about what the political trajectory of the country is, what the economic trajectory of the country is. So that becomes useful, but we can't say the following variable and the following variable have changed, and therefore this is going to be what the move by the rating agencies that you could actually expect. The stuff about the exogenous factors, it's not that we have not emphasized them. They are all there, and the exogenous factors have to do with what is the outlook for US policy. We do not know, and we are not the only ones. Everyone in financial markets and amongst policymakers globally, everyone is trying to figure out what the policies of the new US administration is going to be. Are they going to become more protectionist? If they become more protectionist, what does that mean for the global economy? Are they going to be embarking on a path of fiscal stimulus? If they do that, what is the impact on the US economy? How does it change the dynamics with respect to what the Fed is going to be doing? Clearly, what the Fed does has got ripple effects throughout the global financial markets, and thus the global economy. That continues to be a factor. We do spell out in the statement, by the way, that part of the improvement in the exchange rate that we had seen over the past few months had to do with the fact that South Africa had experienced a positive rise in terms of trade, and that had underpinned the strength of the currency. There have been other factors, including the current account balance, which itself is an outcome of the terms of trade and so forth. So we did take account of all of those external factors, but the risks to the inflation outlook, as we had spelled out this time around, the big factor is the exchange rate, and it had been driven by domestic factors rather than by global factors. Hillary? Yes, Hillary?
Governor, may we ask non-monetary policy questions at this stage?
Well, ask the question and then we will see if it must be dealt with here. Yeah.
Yes, I wondered if you could comment at all on banking regulation, on number one, the court case which was launched this afternoon by the potential buyers of Habib Bank, but also how many banking licenses you are looking at the moment, and what progress has been made, and on average, how long does it take to get regulatory approval for buying a bank or getting a new banking license?
Any other? Miriam?
Thank you. I also have a banking question. There's another, South Africa has one of the best financial systems in the world. There is, however, a court case at the moment which tests the independence or the integrity of and confidentiality of the relationship between banks and their clients, and the rule that there can be no political interference in this. Now, if the court case that is happening at the moment does not uphold this principle, that there can be no political interference between banks and their clients, how is this likely to pose any sort of threat to the integrity of our financial system or the way that it's perceived?
Governor, this is an MPC question from Daniele Messier of Deutsche Bank Securities. Governor, given your concerns over downside employment risk and what appears to be a fragile recovery, how do you see inflation risks over the medium term? More specifically, can you give us an idea of your unit labor cost assumptions in light of recent moderation in wage growth? Thank you.
Okay, we will deal with the non-MPC questions at the end. Are there still any other MPC-related questions? Thank you very much. If there aren't any, Hillary, Miriam, the answer is more simple than you actually thought. The matter is sub judice, and we cannot comment on it. Deputy Governor Naidu, you can talk about the licensing process. We can't tell you how many licenses we are currently considering. We can tell you how many licenses we have recently approved. That we can tell you. And yeah, whilst I still find myself on unit labor costs, I will ask Kuben to deal with that.
Thank you, Chair. Chair, the only thing I'd add to the first part of your answer is that both the Governor and the Registrar of Banks submitted affidavits in the case that you're talking about, and those are of public record, and I think those answer most of the questions that you have. In 2016, we issued 3 what we call Section 13 banking licenses. I would call them provisional banking licenses. That was to Commonwealth Bank of Australia, subsidiary Time, to Discovery Bank, and to the Post Bank in different periods in 2016. They have got 1 year with which to apply for a formal banking license, which is a Section 16 application. And so the law gives them 1 year within which they have to apply. I give an answer on how long on average banking license applications take because they're so different, or the acquisition of a bank, or the acquisition of a significant amount of shares. Because they're so different, you get very significant transactions which could literally take multiple years. You get much smaller transactions which could take a smaller amount of time. It just depends on the volume of information, the complexity of the transaction. So in law, there isn't a time requirement. It all depends on the context and the complexity of the case.
Rashad?
Yeah, look, the unit labor costs are quite critical to our forecast, and in particular, they're quite critical to our core inflation. Now, I think that one of the issues is that unit labor costs are more or less, although unit labor costs have moderated, if you take the last couple of years, they're more or less around the 6%. Maybe an irony, maybe not, but unit labor costs, growth in unit labor costs are around 6%. And the fact that unit labor costs are at that particular level does play an important role in keeping inflation within the top end and the midpoint of the target. So I think that if you scrutinize, and once you look at some of our assumptions, if you scrutinize the outlook and you try to understand why core is although revised downwards a bit sticky, it really is driven by the fact that unit labor costs almost sit with CPI. It sometimes exceeded it, but is showing some downward trend at the moment. Thank you.
Okay, I think that just to add, I think that this links up also to what Hillary had raised about the sustainability of inflation within the target, where that exactly is. We wish we knew exactly where that is, but we would rather be within the target than at 5.9%. The preference would be that the level wherever you are within the inflation target should be a level that, should you be hit by a shock, it doesn't throw you way out of the target, preferably that it should keep you within the target. Ladies and gentlemen, thank you very much. That concludes the business of today. See you in May.